Stephanie. Thanks for joining me.
Thanks, Susie. I'm excited to be here.
Well, we all know that it's critical to protect your family's finances. And as you get closer to retirement, the choices get more complicated. What kinds of protection strategies do you need to think about later in life?
As you head into the 5 to 10 year home stretch before retirement, your financial plan will likely begin to change, especially as you consider shifting from savings to spending your nest egg. You may be looking for stable returns, planning for income in retirement, or you may still be seeking growth potential from your savings. This is where tax-deferred fixed or income annuities can help. This is also the time when you should start thinking about your life insurance needs and if they have changed. Would permanent life insurance be more suitable than term life insurance, for instance? When you've reached retirement, you may want the security of having a guaranteed source of income that can help cover your essential expenses, just as a paycheck did when you were working. And income annuities can offer a pension-like stream of income for life. And now that you are retired, it's important to review your life insurance needs and what, if any, solutions make the most sense for your situation. Annuities and life insurance can help you cover gaps, and they can play an important role as part of a broader retirement plan.
All right, well, let's hone in on the life insurance piece of this. Say someone in their early 60s purchased a 20-year level term policy 2 decades ago. So the policy is now expiring. Should they replace the coverage? How do they make that decision?
This is a common question. A lot of younger families choose term life insurance. Term insurance provides coverage for a premium that stays the same over a set period of time, like 20 years, with policy amounts that can range from $250,000 all the way up to $10 million. It's similar to home or auto insurance in that it's protection against a what if. It does not have cash value. Essentially, it is a use it or lose it. Term insurance can provide a safety net plus peace of mind that your family may be protected in the event you or your spouse should die unexpectedly. Before your policy expires is a great time to reevaluate your situation. Are your kids now adults with their own families? Have you paid off your mortgage, or are you getting ready to retire? If you no longer have loved ones who are depending on your income, you may want to reassess your coverage.
All right, well, what about someone who has a whole or universal life policy? Does this type of life insurance still have a place in a person's financial plan if they are approaching or in retirement?
So what you're talking about is permanent life insurance. It has 2 subcategories, whole and universal, and both cover you for your entire life as long as your premiums are up to date. Universal life insurance generally lets you choose from a single or flexible payment and builds cash value over time. Whole life generally has fixed premiums and guaranteed payout amounts for your beneficiaries. Additionally, some whole life policies are eligible to earn dividends based on the company's earnings. Though not guaranteed, those dividends can help increase the death benefit and cash value of the policy. Generally, whole life insurance may be appropriate for people approaching or living in retirement, especially if they are considering transferring wealth to their beneficiaries. It can ensure that your heirs have immediate access to funds upon your passing. And this can be particularly useful for covering estate taxes, debts, or other expenses without having to liquidate investments or other assets at potentially unfavorable times. In addition, if your portfolio includes assets that are difficult to divide, such as real estate or business interests, life insurance can provide a way to equalize the inheritance among your heirs. This ensures that each heir receives their fair share without having to sell or divide the assets.
All right, very helpful. I want to follow up on the annuities piece of this. You mentioned that annuities can provide a form of guaranteed income in retirement. Are there any guidelines for when someone might want to consider annuities for this purpose, and how much of their savings to annuitize?
Great question. For starters, I think it's important to explain the purpose of guaranteed income in retirement. At Fidelity, we believe that every retiree and pre-retiree should have a retirement income plan that incorporates a realistic estimate of their anticipated expenses and sources of income, which could include savings, Social Security, and an income annuity. When you create your plan, first and foremost, you'll want to make sure that your day-to-day or essential expenses, those non-negotiable costs such as housing, food, utilities, taxes, and health care, are covered by lifetime guaranteed income sources. Guaranteed income annuities can provide that lifetime cash flow in retirement to cover essential expenses and aren't vulnerable to the market ups and downs. They can help reduce the uncertainty of outliving your assets in retirement. Generally, you should not use more than half of your assets to purchase income annuities. And there are a few things to keep in mind, though. You may give up access to the savings you use to purchase an immediate or deferred income annuity, so you'll need to have other money available for those unexpected expenses.
Right, great guidelines, thank you. And another type of insurance many of us consider as we get closer to retirement is long-term care. We recently received this exact question from a client. I'm approaching retirement. What are my options for long-term care insurance?
There are basically two primary long-term care insurance options: traditional long-term care insurance and hybrid life insurance with long-term care. Traditional long-term care insurance is similar to term life, home, and auto insurance, and is also a use it or lose it coverage. There's no cash value, but it's there should you need it. If you don't make a claim, you will not receive any benefits. However, many insurance companies no longer offer traditional policies, and those that do may raise annual premiums after purchase. Hybrid long-term care insurance policies combine your long-term care benefits with a life insurance policy, which provides the policyholder with more flexibility. The appeal of hybrid policies is use it, or use it. Use it for the ability to pay long-term care benefits if needed. Use it to leave a death benefit to beneficiaries if you do not need all of it for long-term care, or use it to surrender the policy for cash value or exercise the return of premium option. Thinking ahead can help reduce financial stress while giving you and your family peace of mind. It's impossible to determine when you may need long-term care, which is why having a plan is so important. The sooner you start thinking about your options, the better. The cost of waiting could mean higher premiums, no guarantee of coverage, and increased health risks. Make sure to consult with your Fidelity financial representative so they can help you understand the pros and cons of the various types of protection solutions available.
Stephanie, thank you so much for all these insights.
Thank you for having me.
To find strategies that can help protect the legacy you're building in your family's financial future, reach out to your Fidelity representative. If you don't have a Fidelity representative, visit fidelity.com/findinadvisor. And for more timely news and thinking from Fidelity's top thought leaders, subscribe to Insights from Fidelity Wealth Management. I'm Susie Allen. Join me again soon.